Is the economy healthy? It's a question that we've been hearing a lot lately. And so today we're going to take a look at what's going on in the economy and how healthy is it actually. Today is February 23rd, 2026. Let's take a look. The state of the economy matters deeply to long-term investors because it directly influences people's portfolios and financial plans. And right now, the data is sending mixed signals. I'm a proponent of having more data. And so when it comes to our health, my wife and I have our blood drawn on a regular basis so that way we can set a personal benchmark for our own health. And I think that this is also true in investing. Payrolls, inflation, GDP, and interest rates, they each tell part of the story. And so at the headline level, the data has been pretty encouraging. GDP growth has exceeded expectations. Inflation's been moderating and continues to moderate. And unemployment remains at historically low levels. So when we look beneath the surface, that's where we start to see that the labor market appears to be at somewhat of an inflection point. In the post-pandemic period, job openings outnumbered unemployed workers by a wide margin. At one point, there were nearly 2 openings for every job seeker. Today, that dynamic has reversed, and there are roughly 7.4 million unemployed Americans and about 6.5 million open positions. That's the lowest state of job openings since late 2020. January's jobs report came in with 130,000 new jobs created and a slight decrease in the unemployment level to 4.3%. However, annual revisions suggest that the total job growth in 2025 was much more modest overall. And at the same time, lower net migration and an aging workforce have reduced labor supply, helping to limit upward pressure on unemployment. Inflation data adds an important context here. The consumer price index rose just 2.4% over the past year, and core inflation has slowed to 2.5%. And measures excluding shelter have moved even closer to 2%. So while prices remain elevated for many households, the pace of increase has cooled significantly. And for markets, this combination, steady growth, moderating inflation, and a gradually cooling labor market can resemble what we would call like a Goldilocks scenario environment. Interest rates have declined pretty modestly, and the 10-year Treasury sits just above 4%, and bond yields remain pretty attractive relative to recent history. Just thinking about the last 10 years, yields were on the 10-year were down at really low levels, and so now that we're just back around that 4%, yields start to look attractive. Lower rates, they can also support both equities and fixed income, but it's important to remember that markets can and do change quickly. So the bottom line is this. The labor market is softening, but the broader economy remains resilient. So for long-term investors, that reinforces the value of balance, discipline, and diversification in planning. So before we go, just a kind of a bit of a nod here to diversification. Diversification is owning the right mixture of asset classes or investments that can perform differently in different market environments. So make sure that you have the right mix, not just a bunch of stuff.